Welcome to the Deep Dive, where we aim to cut through the noise and get you informed fast. Today, we're really getting into something fundamental. If you're funding an idea, growing a business, planning that next big step, we're talking about choosing between debt and equity financing. It's a big one.
It really is. And, this isn't just for the Silicon Valley crowd or big CEOs. If you're an entrepreneur, maybe running a side hustle, a creator, investing in property, or even just dreaming about starting something, how you fund that dream, it can make or break it. So yeah, this deep dive is definitely for you.
Okay, so let's start simple. Business financing. What are we actually talking about here?
At its heart, it's just how you get the money, the capital to run your business, to grow it, maybe expand. We like this metaphor. Think of your business like a plant. Financing is the water. And basically, you can either borrow that water from someone that's debt, you owe it back, or you share your plant with others, give them a piece, and they give you the water. That's equity.
Borrow the water or share the plant. Got it. And today, we're going way beyond just definitions, right? We want to look at real stories, how investors see things, the pros, the cons.
Exactly. We'll cover the advantages, the drawbacks, maybe even some common mistakes people make. The goal is that by the end, you'll have a much clearer sense of which path, debt or equity, might fit your situation best.
Right. So let's start with borrowing the water, debt financing. In simple terms, you borrow money, you agree to pay it back, plus interest over time.
That's the core of it. And it covers a lot of ground. You've got your standard business loans from a bank, obviously, but also things like business credit cards, government-backed loans like SBA loans, Small Business Administration. They often help make lending easier, even issuing bonds, which is like getting a loan from lots of people at once. And yeah, even borrowing from friends or family counts, as long as it's formal, with a clear repayment plan.
Okay, so taking on debt.
Yeah.
The repayment obligation feels like the big thing. But what are the upsides? Why do people choose this?
Well, the number one reason usually is you keep full ownership, 100%. You don't give away any piece of your plant, your business. That's huge for a lot of founders. Control matters. Also, the interest you pay on that debt, often tax deductible. So that can lower the real cost of the loan. And maybe most importantly for some, once it's paid back, you're done, free and clear. No lingering ties to the lender. Plus, it's usually structured. Predictable payments. Some people really value that certainty.
Keeping 100% ownership, that does sound really good. But there have to be downsides, right? Significant ones.
Oh, absolutely. The main one is that pressure you mentioned. You have to make those payments. It doesn't matter if you had a great month or a terrible one. The payment is due. That can be really stressful, especially early on. And high interest rates, they can really bite into your profits, make it harder to actually grow. Plus, lenders often want collateral, security. That could be your house, equipment, maybe even a personal asset. So you're putting your own wealth on the line if things go south.
Okay, let's make it concrete. Say you're starting that coffee shop. You get a $100,000 loan, maybe 7% interest. Every month, boom, that payment's due. Doesn't matter if you sold 10 lattes or 1,000.
Right.
But, and this is the key thing, you own 100% of that shop, the bank. They don't care about your bean supplier or your funky decor, or if you want to open another one. They just want their loan repaid. That's the deal. That's the trade-off right there.
Perfectly put. That's the essence of the debt side.
All right, so that's borrowing the water. What about the other side? Sharing the plant. What if you don't want that constant repayment pressure hanging over you?
Right. That leads us straight into equity financing. This is where, instead of borrowing, you sell a piece of your company, an ownership stake. You're literally selling a part of your plant for capital. You bring in investors who become part owners alongside you. They share in the risks, but also the potential rewards.
And how do people typically find these equity partners?
The ones you hear about most are probably venture capital firms, VCs, and angel investors. These are usually groups or wealthy individuals looking for businesses with really high growth potential. Then there's equity crowdfunding. That's becoming more popular. Lots of smaller investors chip in through online platforms. Or it could be much simpler, bringing on friends, family, maybe a key employee as actual shareholders, giving them equity.
So the immediate appeal here must be no fixed repayments. If the business struggles, you're not personally on the hook to pay back that investment.
Exactly. That's a massive weight off for many entrepreneurs, especially in risky ventures. If it doesn't work out, the investor loses their money, but you don't end up personally bankrupt from that specific funding. But it's often more than just the money. Equity investors, particularly VCs and angels, can bring huge value beyond capital. Think mentorship, industry connections, opening doors. they can add a lot of credibility too. That can be game-changing. And it definitely gives you more breathing room financially if you hit a rough patch, since there aren't those mandatory monthly loan payments.
Okay, that sounds really attractive, especially the idea of smart money, getting expertise along with the cash. But you're giving away ownership, a piece of your baby. That has to sting. And it must come with strings attached.
It absolutely does. That's the core trade-off. You give up a percentage of ownership, meaning you give up that percentage of future profits forever. And crucially, you usually give up some control. Investors aren't passive. They've put money in. They want to protect it, see it grow. They'll often want input on big decisions, maybe a seat on the board. Conflicts can definitely arise over strategy, direction. And yeah, in some situations, if things go a certain way or investors hold enough sway, founders can potentially lose control or even be replaced. It happens.
Let's go back to that coffee shop again. Same $100,000 needed. This time you find an angel investor. They give you the $100K, but for, say, 25% of the business. Now, no monthly loan payment stress if sales dip. That's great.
Huge relief, yeah.
But now you have a partner. That investor might have, strong opinions about your hiring choices or the menu or plans to expand.
They might want regular updates, financial reports.
Right. The risk is shared, the potential reward is shared, but the steering wheel is also shared to some extent.
That's a great way to put it. Shared risk, shared reward, shared steering wheel.
So, putting them head to head, debt versus equity. They really are fundamentally different animals. Can we just sort of boil down the key differences?
Yeah, let's break it down simply. Repayment. Debt needs repaying with interest on a schedule. Equity, no repayment like a loan, but investors expect a return through profit sharing or selling their stake later.
Okay.
Ownership, debt, you keep 100%. Your plant is all yours. Equity, you sell a piece. You share ownership.
Control follows that, I guess.
Absolutely. Control. With debt, you're the boss. Lenders usually don't interfere unless you default. With equity, you share decision-making power with your investors. Could be minor, could be major.
And risk.
Risk. Debt puts the repayment risk squarely on the owner. You owe that money. Equity shares the financial risk if the business fails. The investor loses out too.
What about the cost? Is one cheaper?
Well, cost. Debt has a clear cost to the interest. It's usually fixed or predictable. Equity, well, there's no interest. But giving away, say, 20% of a hugely successful company can end up being way more expensive in the long run than any loan interest would have been.
So when you lay it out like that, it's really clear there's no single best answer here, is there?
Not at all. It's never about which one is inherently better. It's always about fit. Which one matches your specific business, your tolerance for risk, your long-term vision, your personality even. Are you okay sharing control? Do you sleep better knowing you own it all, even with debt payments? It's strategic.
Let's make this even more real. I've got a couple of quick stories, different paths, both successful. First, let's call her Sarah, the debt queen. She started a bakery, potentially predictable cash flow once established.
Yeah.
She took out a $50,000 loan.
Okay, a manageable amount for that kind of business. And because bakeries can have decent, steady income if run well, she focused. She worked hard, managed her costs, and paid that loan off in just 3 years. Pretty impressive. And today, she owns a thriving bakery, making good money, 6 figures, and the key part, she owns 100% of it. 0 external shareholders. Total control.
Nice. Okay, now contrast that with Kevin, the equity guy.
Yeah.
Kevin started a tech company. Very different ballgame. High risk, but potentially explosive growth.
Yeah.
Needed serious cash to scale fast. He raised $500,000, $500,000, but had to give up 20% equity to investors.
Right, so big money, but a significant chunk of ownership given away. But here's the payoff for Kevin. Fast forward a few years, his tech company takes off. It's now valued at $10 million. His remaining 80% stake, that's worth $8 million. Incredible outcome, right?
Yeah.
He has a board of directors now. Major decisions need their approval. Selling the company isn't just his call. The investors have a big say.
So Sarah's got 100% of her bakery, maybe making $150K a year, total freedom. Kevin's got 80% of a company worth $10 million, making him technically richer on paper, but with less day-to-day autonomy.
Exactly. 2 different definitions of success, 2 different kinds of freedom, maybe. Sarah has operational freedom. Kevin has perhaps scale and impact freedom, but shares the controls. It really highlights how the financing choice shapes the entire journey and the end result.
So for you listening right now, maybe thinking about your own idea or business,
Yeah.
How do you start to figure this out for yourself? What are the practical questions?
Yeah, let's get practical. Ask yourself things like, how important is maintaining 100% control to me personally? Be honest. Can my business realistically handle fixed monthly payments, especially in the early days? Or if sales fluctuate? What's my reliable cash flow situation? Is my business idea something that needs huge amounts of capital up front to even get started or scale quickly? Or can it grow more organically? Am I okay with sharing future profits, potentially large chunks of them? And am I okay sharing the big decisions? Do I want partners involved, maybe for their advice and network, or do I just want the capital and prefer to fly solo?
Those are great questions. And based on the answers, are there some general rules of thumb? Like, when does debt usually make more sense versus equity?
Yeah, some general guidelines can help. You typically lean towards debt if you have pretty predictable cash flow already. You really value keeping full ownership and control.
No.
And maybe you need the money for a specific shorter-term purpose, like buying equipment, will generate returns.
Okay, established businesses often fit that mold.
Right, and you'd lean towards equity if you're in a high-risk, high-growth sector like tech or biotech, where profitability might be years away. You really need that mentorship, those connections, the strategic input that good investors can bring, not just their money. Or you simply need to raise a very large amount of capital that would be almost impossible to borrow traditionally.
But here's an interesting twist. It's not always strictly one or the other, is it? You can mix and match.
Absolutely. That's such a critical point. Many businesses use hybrid approaches. It's very common. For example, a lot of startups raise initial seed money through equity, maybe from angels, to prove their concept. Then, once they have traction, maybe some revenue, they might take on debt for the next phase of growth because they can now show lenders they can handle repayments.
Using one to enable the other later on.
Yeah.
Smart.
Exactly. Or think about crowdfunding. Some platforms are for equity, but others are more rewards-based, which is almost like pre-sales, closer to debt in a way. It can also be amazing marketing. And there are newer models emerging too, like revenue-based financing. Investors get a percentage of your revenue for a period, not ownership, not interest exactly. It's flexible.
It really shows that finance isn't static. The toolbox for entrepreneurs is getting bigger and more creative.
Definitely. You have more options than ever before.
Speaking of options and choices, we actually asked our listeners recently, funding a business, would you rather owe money, debt, or share your business, equity?
And the results were fascinating. It wasn't a landslide. Roughly 60% lean towards equity, 40% towards debt.
That's interesting. And the reasons people gave are probably just as revealing as the numbers. I bet you heard things like, I need full control even if growth is slower, right? That's the debt camp.
Yep. Got a lot of that. And on the equity side,
Probably things like, I'd rather build with people than owe a bank, valuing the partnership aspect.
right?
Or maybe my idea needs too much cash to borrow. Exactly. And the classic pragmatic answer, it totally depends on the interest rate.
Of course. It just underlines, again, how personal this choice is. No right or wrong, just what's right for you and your specific circumstances.
Okay, so let's wrap up this deep dive on debt versus equity. If there's one takeaway, it's this. The best financing method is the one that truly fits. Your vision, your tolerance for risk, your values. Don't just chase the hot trend. Figure out your strategy for your journey.
Well said. And maybe one final thought for everyone to consider as they navigate this. Money doesn't just fund ideas or businesses. When you get the financing strategy right for you, it really can fuel freedom, whatever that freedom looks like for you.
Great closing thought. Fueling freedom. Until next time, stay smart, stay focused, and keep making those informed financial decisions.